All right, thank you for watching what is now the ninth episode of Financial Independence Retire Early South Africa. My name is Berg. I would like to say thank you for watching. Hit the like and subscribe button. They really go a long way. Also, I'd like to say thank you to Tebe, right, for helping me count. I keep losing track, but I count because it's interesting. It helped me keep track of my progress. So this is the ninth episode of Financial Independence Retire Early South Africa. Again, my name is Bird, and today I'm gonna do another context, jargon, and definition episode. So clearly I believe these things are important, right? Because I keep doing them over and over again. But I believe that language and understanding are really important for proper business processes and function. So the better we understand these words and these jargons, the more equipped we'll be to participate effectively in businesses, right? So be communicated with, communicate with other people, understand, and just be empowered to take part in business processes more knowledgeably, right? So I share information for knowledge understanding purposes, and as they say, knowledge applied is power, right? So let's share information, knowledge, and just keep empowering ourselves, right? So financial independence, retire early South Africa. The first definition for today is inflation, right? So just bear with me. Inflation is the decline in purchasing power of a currency over time. The quantitative estimate of the rate at which the decline in purchase power occurs. So it can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over a period of time. So basically, if basic goods and services cost you 4,000 rands this year and happen to cost you 4,500 rand next year, that 500 rand difference in percentage is calculated as inflation. So it's basically the purchasing power of your currency has gone down, and we measure that in inflation. The next word we have is accrual, right? So accrual is the accumulation or increase of something over time, especially payments or benefits. So basically, if you own an asset or anything in accrual, it means that it's going to accumulate or increase in payment or benefit over time, and that will be accrual. The next word we have is a capital good. So a capital good is like a physical asset, right? And then capital goods give us capital gains. And what capital gains are an increase in the capital asset's value, and it's usually said to be realized when the asset is sold, right? So these are short-term or long-term, and they're declared in taxes. So if you have a capital good, like an asset, and it increases in value, the increase in value is considered a capital gain. But then that capital gain is realized once you sell that asset. And in your tax declaration purposes, you mention whether you've had that asset for long or short term, because that does make a difference in your tax statement. The next word we have is depreciation, right? Depreciation is just an accounting method of allocating the cost of a tangible physical asset's use over its useful life expectancy. So basically, how much of an asset's value has been used up. So the wear and tear of an asset, but basically, just how much value your asset decreases in due to wear and tear or just use over time, and that depreciation in value, or that decrease in value, is measured as depreciation. The next word you have is proprietary, right? And that's why I do these things, because I speak about 6 languages. English is like my third language. So for people like me who just we learn English on the job and we're learning these things on the go, it's important for somebody to tell us what these words mean, because we aren't native English speakers, right? But the more equipped we are, the better we can make informed decisions. So the next word we have is proprietary. Say it with me. Proprietary. Proprietary just relates to ownership and owners. For example, in the context, something like proprietary information just means information that's confidential, or like a trade secret belonging to the company, right? That's its proprietary information. And then proprietary software. Proprietary software is basically software that's a property of an owner or group of owners, and then everybody else's, the end users, use that software in the defined limitations that are set up by the owner, right? So proprietary software is property software that has an owner, but the end users use it within the predefined conditions, right? And then proprietary, again, in the context of proprietary rights, can be also used the same way as property rights. So proprietary rights and property rights can be used interchangeably, in the sense that they mean your right to own tangible or intangible assets, right? So proprietary, you have proprietary information, proprietary software, and just proprietary rights. Relating to ownership, proprietary information is just confidential information or trade secret. Proprietary software, software that belongs to an owner, and everybody else, end users, use it within predetermined conditions. And then proprietary rights just mean property rights, your right to own tangible and intangible assets. And then our next word is fiduciary. right? And then fiduciary is a person or organization that acts on behalf of another person or persons, putting the client's interests ahead of their own with the purpose to preserve good faith and trust. So you're basically legally and ethically obliged to work in the best interests of the other group or individuals. So, for example, if you have fiduciary duty, it's said that, as a director and as executive in a company, your fiduciary duty is to put the business's rights ahead of your own, but only in the sense that you avoid conflict of interest, you don't exceed the company's powers, and you account for profits and losses. So fiduciary just means you're a person organization that works on behalf of other people, right? And you put their interests ahead of your own, and that fiduciary responsibility means, you do not work outside the conflict of interest, you do not work outside the scope of your powers, and you account for profits and losses, or profits of losses in the company, because that's your fiduciary responsibility as an executive or a director. And then we move on to our next word is moat. Now, if you know what a moat is, castles used to have like water around them with the bridge that, and that water was basically so that people aren't able to like easily jump onto the castle or easily get onto the fort and attack it. So that water is like a security moat, right? Or that water is a moat which is used for security. So in business, a moat is a business' ability to maintain a competitive advantage over its competitors in order to protect long-term profits, market share against competing firms. So in business, if you have a moat, it either means maybe you have a lot of money, or you have like a technological advantage or a technical advantage that will keep you just ahead of your competitors, right? So a business's ability to maintain competitive advantage over its competitors in order to protect long-term profits and market share. And that's a moat. So just like in the ancient times, a moat is used as security. But in this instance, the security, whether it's money or technology or just, not necessarily inside information in the wrong way, but basically your company has the ability to protect itself from competitors, right? And that ability, whether it's money or technology, can be called a moat, right? Then when I move on to the next word or phrase is opportunity costs. So opportunity costs are losses or benefits that could have been made if the best decision, right, was taken, or the best action was taken. So basically, shoulda, coulda, woulda, right? It's money that you shoulda, coulda, woulda made, right? Opportunities that you shoulda, coulda, took. So basically, it just reflects on your how efficient you use your income, scarce, because income is scarce, right? But how effectively you use your income and how effectively you are a decision maker. So the better decisions you make and the better you allocate your capital, the better your returns, and then you'll be able to take advantage of, any good opportunity, right? So if you're unable to take advantage of these good opportunities, then you took what is called opportunity losses, that losses are considered opportunity costs, because you were not in the right position to take advantage of that opportunity because you don't use your resources effectively, or you don't know how to make the right decisions at the right time. And, that money that you could have, should have made, or that progress that you could have, should have made, is measured as an opportunity cost, right? And then moving on to our next phrase, we have CAC, CAC. That's customer acquisition costs, or costs of customer acquisition. It's in the name, right? Customer acquisition costs or costs of customer acquisition. So basically what that means is if you spend like 100 rands trying to get customers, $100 trying to get customers, and you eventually only get like 100 customers, right? So you say $100 over 100 customers, that's one, or 100 rands over 100 customers, that's one. So effectively you spend 1 rand to accumulate every customer, right? Because all of the money you spend on marketing, advertising, and just whatever you did to get your customer only got you 100 customers. So that $100 you spent, or the 100 rands you spent, versus 100 customers that's divided by each other gives you 1. That means that your customer acquisition cost, or you spend 1 rand to acquire a customer, or you spend, I should stop with this dollar thing, right? Well, basically you spend 1 rand to acquire every customer. The next phrase we have, DCA, an investment strategy in which investors divide upon the amount periodic purchase of target assets effect. Oh, dollar cost averaging. Oh my God, I'm so sorry. Dollar cost. There's so many costs in business, right? So this next phrase, DCA, is dollar cost averaging. So dollar cost averaging is basically an investment strategy in which an investor divides up the total amount to be invested across periodic purchase of targeted assets in an effort to reduce the impact of volatility and opportunity costs, right? Again, so an investment strategy in which the investor divides the total amount to be invested across a periodic purchase of targeted assets in an effort to reduce the impact of volatility and opportunity costs, something that's called the constant dollar price. So basically, you're trying to buy shares, so you dedicate like 500 rand to buying shares in your favorite company every month. So if the share is 100 rand this month, it means you got 5 shares, right? If the share price is 120 next month, it means you're going to get 4 shares. But if the price is 80 rand this month, it means you'll get 6 shares, right? So basically, you're committing the same amount every month, which is 500 rand, but depending upon the price of that share or the price of your asset, you get a different number of assets, but your fixed purchase point is the same, and that helps you in maintaining certain risk against volatility. And also, you buy more shares when the price is cheaper, and you buy less shares when the price is expensive. It also helps with avoiding trying to time the market, right? It just means that time in the market is better than timing the market, right? It's very difficult to wait and say, oh, I'm gonna wait for the share price to drop and then buy it, right? Or be like, oh, I'm gonna wait for the share price to be high and then sell it. But basically, you just, in a long-term sense, buying the same company or the same asset using the same price point in order to avoid risks that happen with volatility, and also to take advantage of opportunity costs. So it's called dollar cost averaging. So your costs are averaged out every month because you use the same amount to buy your asset, right? So it's called dollar cost averaging or constant dollar pricing, right? I don't know if that makes sense. That basically you have a fixed cost to your asset monthly, but the price may fluctuate. So having that fixed cost monthly helps with that fluctuation in price and volatility, but also it helps you take advantage of opportunity when there is opportunity, So the last one we have is coupling and decoupling, right? Coupling and decoupling. But basically, coupling and decoupling is when, or coupling for starters, is when value chains or companies with the same global like supply chain systems then start having mergers and acquisitions, right? So it's basically companies that have the same value chain or exist in the same value chain or the same industry, or maybe companies that like I said, have the same global supply chain, start having mergers and acquisitions. Though they're coupling because they're coming together. That's coupling. And then decoupling is the opposite of that. Companies within the same value chain, or companies within the same global supply chain, or even countries, right, within the same global supply chain, start not necessarily working together as effectively and coming apart, and then that's called decoupling. So in the obviously in the context of countries, it's determined by laws, um, trade trade tariffs and things like that. But basically it just means that now these companies aren't working together as effectively anymore, so they're decoupling. But if they're coming together, then it's called coupling, right? So to go again, today's words were inflation, accrual, capital goods, capital gains, depreciation, proprietary, fiduciary, fiduciary responsibility, moat, opportunity costs, customer acquisition costs, uh, dollar cost averaging, and then coupling and decoupling. Those are the words that we have for today. And again, I hope that these words help you just as much as they help me to be able to receive information that much better and make more informed decisions. Again, please hit the like and subscribe button. It goes a long way. Thank you for watching. My name is Bird, and this is Financial Independence Retire Early South Africa. Oh, I'm going to leave like my number, my WhatsApp, my Facebook, how it goes. I'm going to leave all of my community details in the description. So just hit me up, text me, call me, DM me, follow, like, subscribe, all of that. Appreciate y'all.